Welcome to the price action and chart pattern masterclass, and in this really special video I have collected the 13 best price action and chart pattern strategies and almost 100 chart studies. So let's start with the daily high low, which is a really interesting concept for higher time frames, but also when you're a day trader on the 5-minute or lower, this is really helpful. So when we're starting on the daily time frame, we want to always observe and analyze the daily lows and also the daily highs. So for that, we take a look at the daily lows, which is here marked with the red line, and the daily highs with the black one. And what you'll see in an uptrend is the market is continuously pushing into a new daily high. So here we have a period of highs, the market is pushing over and closing above them, and the market is never able to take out a daily low. There's one small exception here, where the market after this impulse move broke a daily low here for once. However, this is the only time this is happening during the uptrend, and the market is always failing to take out daily lows. As long as the market is not able to take out a daily low, that's a really bullish trend structure. And let's keep analyzing the price here. After the sideways period of the market just moving sideways, the market was not able to take out a high, and then the market is for the first time taking out here previous daily lows. This is not a very strong breakout yet, but it's the first indication that the market might be shifting. And then you can see it here. We were getting ready for the next day. The market pulls back here into the first high, and then we are taking out the daily lows for good. And this is then often the starting point for a prolonged downtrend. You can see the next candle, the market pushed higher into the previous daily candle and eventually took out another daily low, continuing the new downtrend. And this is then the downtrend that is emerging here. The market keeps taking out daily lows and is not even coming close to a previous daily high. And that's a really important trend structure and thing that you can note on your chart. So even if you're a day trader, I would recommend at least one time per day, go to your higher time frame, check the daily highs and lows and see how the market is trading into them. On TradingView, there's a free indicator. So when you go to indicator and type in daily high, you will see this one, daily high low. The creator is Unknown Unicorn, and this is freely available on TradingView, and this will plot this channel. So now we're on the 1 hour chart, and the indicator gives you the daily low here and the daily high in green. And you can see that during this uptrend, except for this one time the market violated the daily low, quickly rejected it, but was not able to close and really trade a prolonged period below the daily low, and then continued to take out daily highs until the market changes its structure here. We take out the daily low, retest it underneath as resistance, and then really change, and the market keeps pushing into daily lows and fails to take out or even reach daily highs. Next, let's talk about fair value gaps and order blocks. So what you see here, we are starting on a 4-hour time frame, and we want to analyze the price structure. First thing we see is a local fake out. The market is in a downtrend. Here is a local low, and then the market is first taking out the low, but with the next candle is rejecting it very strongly, almost an engulfing candle, and this is then a sign of a fake out. This is a sign of weakness in a downtrend. This typically doesn't occur in a healthy downtrend. Previously, when you see and when we analyzed the previous downtrend, the market took out daily lows here easily and continued to push lower. Here we have a break below a low and then an immediate rejection. When we zoom out, we can see that this fake out is occurring at a demand zone. This is the origin of this uptrending market. So this is a very strong demand area, and it's a great local confluence factor. When we zoom back in and go to a lower time frame, this is the demand area that we have observed. This is the fake out. And then here we have the trend change. Some traders may refer to this as a break of structure or a market structure shift. The market is now taking out a local high, and this is then signaling a short-term change in the trend structure. When we wait a few candles later, we never want to buy and chase the market on the way up. So after the strong breakout, you don't want to jump on a long trend or long trade just yet. You want to wait for a better entry price. What we see is that the market on the way up is leaving this order block and the demand zone. Here, when we mark the high and the low of this candle before this really strong breakout, we see that we have this demand zone created. And this now becomes a really interesting price level on our charts. If the market pulls back into the zone, we want to look for long continuations. Remember, we have a long idea on the higher time frame after the fake out into the demand area. So what we do is we wait for the market to come back into demand area here. We want to see that the market is finding support at the demand area and the order block, And then once the market breaks higher and shows us that the demand area is holding and the price is really using this as support, that's where we want to find an entry. The stop loss can be placed below the swing point, and then for a potential target we can just look left and we look for a previous swing point here. And that could give us then a very nice 3.47 reward to risk ratio. And what you can see, the market first struggled a little bit, never really challenged the demand zone again. So that's a good sign that the market is continuously staying above the demand area and then easily hitting our take profit target. Next, let's talk about trend lines and especially the trend line flip and the bounce. So here we have a little bit of a complex chart pattern. What we see is that the market has a resistance area that led to this downtrend. The downtrend seems to have turned here. And then we have an uptrending market that reached the other resistance area. And this is a tap and an exhaustion pattern. We're going to learn this pattern in depth more in later parts of this video. But what we want to focus on are the confluence factors and the local levels. Here we can very nicely define this long-term range structure, which we also might call a distribution pattern. When the market is moving so long sideways, it doesn't become a great corrective wave, so the likelihood of a trend continuation is much lower. And here we have a confluence factor and a confluence level where the short-term level here of this pattern and the long-term trend line are coming together. If the market is able to break below that, that's a great sign of weakness. And we get that a little bit later. What we see is the market is breaking those two levels. It's breaking here the lows. This means that the market is now making lower lows. It already made lower highs here. We broke below the trend line confluence factor here. Then we retested this all as resistance. It previously was support. And the market immediately rejected this. Another great indication that the market is now shifting to a more bearish dominated market and the buyers are not as strong anymore. And you can see afterwards the market really rolled over very nicely here. Let's take a look at another example. What we have is a downtrending market and we can very nicely define the downtrend with this bearish trend wave. The market is coming back into the trend line and is finding now resistance. What we also can see is when we map out local lows, we can see that previous support turned into resistance and it did the same here. Support turned into resistance. So right now, when the market is between long-term support and resistance, I would consider this a neutral zone. And it's really helpful in your trading if you understand when the market is in a neutral area, because that helps you to understand when you don't want to trade. You want to see the market get above this for a bullish idea, and you want to see the market make lower lows, as we've seen in the previous example, to see a downtrending continuation. We see the breakout, the retest, and then the market moves to the downside. So you can very nicely see how this long-term trend line acted as resistance here, here, here. And then we had first signs that the market might be slowing down a little bit. But if we map out the structures and the levels, we can come up with very good trading plans that help us trade objectively and with a plan. So we're trading in the long-term downtrend, we have our levels mapped out, and then we just wait for a break and a retest. Next, we talk about the Quasimoto pattern. So what is a Quasimoto? What we see is that the market is in a downtrend and everything looks really bearish. We can also see that the market started to make slightly higher lows. However, the lows are not really very bullish because they just barely move higher here. What we see is that we have short-term breakout momentum. The market is clearing it and it looks like we are continuing the trend to the downside after the market cleared this weird correction. However, this is really important. The market is immediately pushing back into the zone and this might look like a fake out now, right? So we want to be careful. Do we want to go long just yet? Not really, because the market has not really cleared here the resistance to the top side. And that's a very important distinction that you can make here on this price chart. Immediately after the market pulls back into this area, we see that the market is reversing into the downtrend. So we always have to keep in mind, what is the long-term trend direction? The long-term trend direction was down here all along. We had a weak correction here. There was not a lot of bullishness in the market. So we have to understand that those corrections are very natural. The market just rarely moves into one straight line after a strong downtrend. The likelihood for a corrective wave is a little bit higher because people who sold this on the way down are now taking profits a little bit. So we have to stay calm at the sidelines and wait for the market to give you a clear signal. Here it's also really important that you don't just jump on the trade just yet. This initially looked like a fake out, however the market is not taking out highs. This is really important. When the market is not taking out highs, you should not go long. A lot of traders will get caught up in those quick volatile bursts, and it's really important that you map out your levels in advance. You're aware of the trend structure, you know if you're in a downtrend or in a long-term uptrend, and then you map out your levels, and you know that if the market is not breaking into your new high, you're staying at the sidelines and you're not trading. Let's take a look at the concept of deceleration in combination with a pin bar. And this is one of my most favorite candlestick patterns. Whenever I see such a pattern, I pay very close attention to this chart. What we see is that the market initially was in a strong uptrending move. Then we have the neutral pin bar where the market didn't take out the highs here. And then we suddenly see strong selling coming into the market where the red candle is closing below the low of this previous candle. So this is often a sign of a bearish reversal. When we go now from the 4-hour to the 15-minute chart to look at the microstructure, this is how this 3-candle pattern looks on the lower time frame. Strong trend, another trend continuation. We fail to take out the highs. The market starts to make lower lows and lower highs here, and we have this level here. We have a good level that we can work with. Whenever we have a horizontal level that nicely defines and describes the price action, that's a great starting point. Horizontal levels are always preferred over trend lines because they are more objective. We can also add the Bollinger Bands to our charts, and what do we see is that on this top here we have a Bollinger Band squeeze. The Bollinger Bands are coming very close together. This shows that the market is building a lot of pressure. The market was very unactive or inactive, and what we want to see are rejections. So what do we see? We see the breakout into the lower Bollinger Band below this support level that we have marked. Then the market comes back, tests this level from underneath, and also rejects the Bollinger Bands. The rejection of the Bollinger Band in a trending market can be a very strong signal. So this is now looking like a great entry pattern. We have the trend that seems to be reversing, and we have the rejection. And now what we want to see is a clearance of the lows. We are breaking the trend line, and that is then often the starting point for your downtrend. So we knew that on the higher time frame we had more likelihood of bearish continuations after this pattern, this 3-candle deceleration pattern. On the lower time frame we saw the breakout and the retest, the rejection of the higher Bollinger Bands. You don't want to see the market close outside of the Bollinger Bands, such as what had happened here. When the market closes outside of the Bollinger Bands with a strong candle, that's not a good sign to go against it. Here we close above the Bollinger Bands and we continue higher. Here we close above the Bollinger Bands and immediately with the next candle reject the Bollinger Bands. And in this context, this is a great entry signal, and then you can see the market moved lower. Let's take a look at wave ratios and how we can understand trend ratios. So what we see is that we have a lot of bearishness here. The market in this short amount of time sold off quite a bit. And when we look at this corrective wave that followed this strong impulsive wave, we see that the market is not able to push higher a lot. The market from the low here just made it to here, the highest point of this range. So we have strong selling and weak buying. And it's really important that you get into the habit of analyzing trend waves. You have strong selling, weak buying. What does it tell you? That the market is more leaning towards the bearish side and the buying interest is not super high in such a market. When we get rid of the boxes and when we activate the pivot points and just look at the price action, we see the strong downtrend. Here we have the weak corrective wave. The market is trading into the pivot point. This is actually the weekly pivot point. The market is using the pivot point here as resistance in the past. Here we had a flip of the pivot point. It used it as support, broke below it, used it as resistance. The market moved lower. We trade back into the weekly pivot point. We have 1, 2, 3 rejections. Another strong sign that the market is not really bullish. And we're going to wait patiently for our bearish trading plan. The trading plan is, when we look back, here is a support level that I've marked now here. We wait for the market to get below this. What is happening here after the breakout? The market is coming back into the stop area. It retests it, and then the market moves lower. So it's really important to also be aware that if you are a breakout trader, you get in short here, you don't want to put your stop loss too close. You want to give your trade some room. And you can see we have a little bit of a spike here, but we don't move very far into the stop area. And then here you can see the strong bearish candle. This is often the case after the market is hitting here the stop zone. In that case, we don't move very deeply into the stop area. We just test the low of the stop area, and then the market moves lower. So we know, again, where did we start? We started with the analysis of the trend ratio and the wave ratio, strong selling, weak buying. We have the resistance that the market is not breaking above. We have the breakout out of our pattern. We know there's the stop area. In that case, we don't move very deeply into the stop area. We just barely hit it, and then afterwards the market rolled over. So we knew all along that the market is more bearish than bullish, and then we created our trading plan with the help of our other tools. The Deadcat bounce is really common and very famous pattern. You will often also observe it on a stock market where it can really foreshadow great trending price moves. So what do we see? We have the market moving higher. We are clearly in an uptrend, and in an uptrend we want to pay attention to the highs. Here we have a high, and then the market made a significantly higher high. And then from here to here, the high is not as meaningful anymore. It also takes the market much longer to move from here to here compared to how the market accelerated on the way up previously. And then from this high to this high, the market is really barely taking out the high. So very strong indication that the uptrend is losing steam. It's losing force, and the market might be slowing down. We also want to analyze the lows. How are the lows treated in an uptrend? For now, the market keeps making higher lows. And as we've learned in the beginning, as long as the market is not taking out a previous low, you're not really in a downtrend. So you can say right now the uptrend is still in play, but we are seeing weakness. So we want to be very observant, and we want to pay close attention to how the market is retesting and treating the lows. And what we see is that here the market is treating the lows, we have breaking the lows, we have a break here and a retest of the trend line to the downside. The market rolls over and is then starting the downtrend. What we see is that the market is moving lower. After the breakout, we have our first corrective wave. We have a pivot point rejection. So the market tried to break the pivot point, but again with the next candle immediately rejects it. When you see those immediate rejections, be it the pivot points or the Bollinger Bands or just natural support and resistance, you have to pay close attention, because this can again help you understand the buying and the selling ratio. In that case, we have a lot of selling and we had just short-term buying. So not really convincing that we should look for a bullish idea, especially if we have previously seen here with the triple tap, the exhaustion in the market. And then the classic trade idea, we wait for the market to take out the low. Here we break out of the trend line, we take out local lows, we retest the trend line from underneath, and then we are back to strong selling. So the initial rolling over period from an uptrend to a downtrend, the initial period, the first impulse and corrective wave might not be super strong, so you might not be able to catch very large trades, but you really have to start paying attention to those first corrective waves. The first corrections is then where the remaining buyers are now driven out of the market completely, and then this happens off this vertical drop where only sellers remain and the buyers are completely withdrawn in the market. Let's focus a little bit more on the triple tap because it's such a powerful concept. So again, we see here an uptrending move and we want to pay attention to the highs. We have a high here, we have a high here, and we have a high here. Whereas previously the market strongly rallied here. From here to here, the market just made a short continuation. And then from this point to this point, first of all, it took the market much longer. We had a lot of time where the market trended lower here first. The market eventually made a higher high, but that's not very convincing. We also see that the market is heading here this pivot point. And whenever the market hits the pivot point, we really have to pay close attention, especially if we can see some nice pattern, or in this case, the triple tap here. Again, what happens is we break the trend line, we take out lows, we have the first impulse, the market corrects back lower, we have a strong push, and now we're testing previous lows as resistance. And then the market really sold off. So again, the same rhythm applies. We have the triple tap, the market on the upside from the bullish period is exhausting. We have the first break, the retest, and after the first corrective wave is over, and that's where you often then can witness the vertical fall. The 1, 2, 3 pattern is really famous pattern. Many professional traders trade it. It's also a cornerstone of smart money concepts or ICT. So what do we see is here, the downtrend seems to be fading. We go over into a long-term accumulation phase. We don't have a short-term correction. It seems like the market is moving sideways. We start to make here higher lows, which is another bullish signal. We have here the breakout to the upside. Let's put us into the shoes of the breakout trader. The breakout traders will go along here or maybe a little bit earlier. Their stops will all be clustered in this zone, right? So if we want to specialize trading the 1, 2, 3 pattern, we don't take the initial breakout. We want to wait for the market to move back into the pattern. In some cases, you need to be patient, but you really want to wait for the market to dip back into this zone. We hit the stop zone, so we have our first corrective phase here. We're hitting the stop zone, and now we want to carefully observe and analyze the price action. We don't just go long because the market is hitting the stop zone. We want to see strong buying coming back. The strong buying comes back here once. We take out the lows once again. The strong buying after we dip deeper into the stop zone comes back and even stronger. So you can see every time we hit the stop zone, we see strong buying here. We see strong buying here. You might hop onto this first trade here and get taken out, but you get a second chance. We have the fake out and strong buying comes immediately back, and then the market moves higher. So sometimes the signal will not work out in the first time, but if you get a valid signal the next time and nothing changes on the whole chart context, you might be able to find a re-entry. Let's talk about pin bars and tweezers. So a tweezer pattern is nothing else but a double pin bar. So we have a pin bar here and a pin bar here. This is great because the second pin bar poked above the first pin bar, took out the highs but rejected the highs, and then even closed here into new lows. Remember in the beginning we learned that when the market is taking out lows, that's a strong signal. It's not taking out highs, it's even rejecting highs and then taking out lows. When we zoom out a little bit, we want to understand where is this pin bar tweezer formation happening. We see that the market is in a downtrend. We have previous support, the market broke below it, and it's coming back to retest this. So the pin bar tweezer makes a lot of sense here. We can activate the daily moving average, and what we see is that this is also a confluence level. So we have the previous support turning into resistance. We are in a downtrend, and we see that the market is hitting this moving average. So a lot of great confluence in this price zone. When we now go to a lower time frame, what we see is that this tweezer pattern on the higher time frame on the lower time frame looks like a triple tap. Strong trending move, weak continuation, and then here another weak continuation. The market is closing here above the highs, but previously, prior to this high point, the market sold off quite strongly here already, so that's another very important hint. And then after the market made this high, we have a really strong series of selling. We take out the lows, so now the market is taking out the lows as we have observed by just looking at the bodies of the two pin bars on the higher time frame. So on the lower time frame, this is now a market structure shift. And what you can see after the retest, the market sold off and made this downtrend. So we started on the higher time frame by looking at the tweezers. The tweezers gave us the signal that we want to look for short opportunities. It happened at a great location, previous support turning into resistance. On the lower time frame, we get this great price pattern. We wait for the breakout, we trade the retest, and then we can find those new trending moves very early on. Let's talk about trend exhaustion next. What we see here is we start with extreme selling. The market almost dropped vertically, and after the market made this low point, we moved sideways for quite a bit. This is not a sign that the market is rolling over. It is just the first indication that something might be changing here in the price dynamic. The market made a lower low, but again, a very weak lower low. When we look at this low here, we look left, the market just barely broke the low and then immediately shot back into the pattern. So we would call this an accumulation pattern. When after a strong trending period, the market goes over into a prolonged sideways market, this is then becoming an accumulation pattern. What we see is that the market is making a higher low. This is the first higher low after this weak rejection here, and another bullish piece to the puzzle. We don't go long just yet, but we know that more and more bullish signals are stacking up here, and it might start turning bullish. We see that the market is pushing higher here. We have here the breakout to the upside. When we look left, we can see here is an order block. Here we might have another supply area. So those can be then used for your targets. You can see the market broke out. We had a little bit of a corrective wave, break, retest, and then that's where it started. Again, the first impulsive and corrective wave are often phases where the last few sellers that still remain here are shaken out of the market. The new buyers are slowly coming in. And once all of the previous sellers have been pushed out of the market and only buyers remain, that's where you then see the vertical move to the upside. We take out the first target and then we move into the second target. Let's close out by looking at market symmetry. And what we see is that we have an impulsive wave, we have a corrective wave, and another impulsive wave. But there's a rhythm behind those moves. And when we draw our Fibonacci from here to here, we can see that on the way up, we hit the 50% level. So this is exactly the halfway point of this previous impulsive wave. So the impulsive wave moved to the downside. The corrective wave was only able to cover 50%, only halfway. And then the market moved to the downside. What we see is, again, strong impulsive selling, weak buying, strong impulsive selling. We want to always observe those corrective phases. If a correction goes on and on and on and on and is almost hitting a previous high point, that's not weak buying anymore. That's then a sign that more and more buyers are coming in and fewer sellers are in the market remaining. And we can even see this on a larger scale. So when we zoom out, this is our first example. We have strong selling, weak buying, strong selling. But when we zoom out, we can see we have strong selling here, weak buying, and strong selling here. So we can see this on a macro level, on a micro level, on the long-term time frame, on a short-term time frame. This is a very common occurrence and a lot of trends will unfold in this way. So really start paying attention to wave ratios and to how strong or how weak buying and selling in the market that you're observing is happening and occurring on your charts.